In this video, we're going to talk about understanding important trading terms. Now, I'm going to briefly discuss these terms because I've learned that most of our group are not totally new to trading. So a lot of these basic terms you already know. You may have learned them from Baby Pips or another website or another academy. So I'm putting this together just to recap. But if you would like me to do a deeper dive into any of these or all of these, please let me know in the comment section and I'll make a more detailed video. So the first thing I want to talk about now that we're talking about performance is just understanding our balance, right? So the balance is the total amount of money you have in your trading account. Okay. So that's our balance that we find right there. That's closed. That's our closed P&L, closed profit and loss, right? So if we have any floating, what is called floating P&L, any floating or open positions, that will not be captured in the balance. Okay. So the balance is the closed positions, closed profit and loss. Okay. So now the equity. Now, what is the equity? See, the equity is the balance plus or minus, right? Plus profit or minus loss, right? So if you have open positions, then you'll find that the amount that is either floating in profit or floating in loss, that will be the equity amount. Now, the reason I'm showing these is because this is all important and connected to margin and margin calls, which we're going to discuss here. And if you're trading a funded account, when you're trading with FTMO, the drawdown rule is related to your balance and equity, right? So if you go into drawdown, you have floating loss beyond the max daily loss, right? Or beyond the max loss if your equity goes beyond that. Not saying that the account was closed, right? Your balance may be, let's say your balance is 100K, but if you go, their max daily loss is negative 5,000, right? On a 100K account, it's basically negative 5%. So if your balance is 100K, but you have open positions and you go into a negative 5K loss, okay, bringing your equity to below net 95, then you'll get kicked out, right? So this is why it's important to understand balance and equity. Your profit and loss, okay, which is commonly nicknamed P&L. So if you talk about P&L, you'll hear me talk about P&L. We'll be talking about P&L. That's your profit and loss, right? That's the difference between the amount, like if you start a day, right, at 5K, okay, so you see here in this desktop view, the start of the day was at 5K. Okay, this is showing for maybe like a few days here. So at start, the balance was 5K, but over these amounts of trades, the balance became 5,016. Okay, so the profit and loss here is $16. So you see profit and loss here, $16.71. Okay, so that's the profit. So you have P&L. It can be calculated for the day, it can be calculated for the week, it can be calculated for the month, it can be calculated for the quarter, calculated for the year, right? That's how much you made or lost for a given particular time period. Okay, all right, now leverage. So leverage is a double-edged sword because when you open up a live personal account, the leverage is a margin loan, right? It's a loan basically because you put in $100 and the broker offers you a certain amount of leverage, which is a loan. Basically, you put in $100 and they loan you a certain amount of money so that you can trade with higher capital, okay? So let's say if you have, you deposit $100 here and the leverage is 1 to 10. This is meaning for every dollar, they're going to match you with $10. So actually, if you put $100 in, you actually have $1,000 in your control. Okay. That means you have the power to buy with $1,000. So with that being the case, you can make a lot of money. You can put $100 in and you can make a lot more money because you can purchase more, right? You can buy more assets, right? But it's a double-edged sword because if you go negative, you can easily lose this $100, okay? And it gets, so the double-edged sword, it gets more rewarding as you have higher leverage. So there's brokers that say, hey, for every dollar, we're going to match by 500. So for your $100 that you put in, you get to trade as if it's $50,000. Now on the reward side, that is great because it's almost unlimited reward. But on the risk side, right, it's not unlimited. So that $100 can go just quickly. And they know the nature of people. So they're gonna, some brokers will say, oh yeah, we offer 1 to 500 because they know you're gonna over leverage. They know you're gonna blow the account and they're gonna make money. Okay, they'll get to keep that money. So the leverage is a double-edged sword. If you're doing a funded account, then I would only just take a look at leverage to ensure it's high enough to trade the instruments you want to trade, right? So when I was trading one of these prop firms, I'm not going to mention who it is, I didn't have enough leverage. I found out that their leverage on US 30 was 1 to 10, when normally with FTMO it's 1 to 100, right? So I could only take out one position. I'm trying to enter into another position and it's saying I don't have enough margin. So you want to be aware of this. And when you searching for a broker, try to go 1 to 100. When you're searching for a prop firm, look at 1 to 100. Try to get a higher leverage. Okay. All right. Now, what is the margin? As I mentioned, right? The margin is the amount of money you've deposited in your account that will cover potential losses, right? It is a good faith deposit. It is the amount you have to have in your account to keep a position open. So let's look at the numbers. So you have an initial deposit of 1,000. Your leverage is 1 to 100, meaning the required margin in your account is 1%. Okay. 1% of whatever you're purchasing. Okay. So if we purchase 10,000 of Euro USD, we buy 10,000 of Euro USD. 1% of 10,000 is $100. So as your balance may be at 1,000, and as long as your account doesn't go down to 100, then you'll be okay, right? Hopefully you're not losing that much. You have proper risk management, but the broker will allow you to continue to open more positions and trade if your account has not hit 100. Okay, so we're going to talk about what it means if your account actually hits 100. Okay, if it goes all the way down like this. So the margin level, there's something called the margin level. So the margin level is shown as in a percentage, and this is the health of your account, right? So for example, let's say we have an equity. Okay, our equity is at 10K. The margin used is at 2K. Our margin level, the formula is equity divided by margin times 100. Okay, so 10,000 equity divided by 2,000 times 100 is 500%. That is great. Okay, so remember, there's a margin required, and it's given in percentage. So the margin level is also given in percentage, so you can easily compare the two. Okay, so let's look at the free margin. All right, your free margin is the amount of money that's available for trading. Okay, so here we go. For example, let's say we have equity of 12,000, a balance of 10,000. So that means that we have a floating profit of 2K, right? The leverage is 1 to 50, meaning that we have a required margin of 2%. Okay, required margin of 2% of what we're purchasing. Okay, so the assets that we bought are 100K. All right, so the free margin is the equity minus the required margin. So if we bought 100K, 2% of that is $2,000, right? So the free margin is this number here. So you'll see that free margin in the MT4, and that's what that means. It's the amount of money in your trading account for trading that you have left, right, to open up some more positions. All right, so a margin, we'll talk about margin call. What's a margin call? So a margin call is an alert to say, hey, your account is doing bad. The margin level is low. Hey, you may want to close some positions. You may want to do something else. You may want to you may want to control your risk because your margin level is low. So if you look at brokers, they'll normally have a margin call level. They'll tell you at a certain percentage when they'll alert you that your margin is low, right? So for example, we have the balance is 10K. Your losses is at 7,600. The used margin is 2K. So the margin level, again, is the equity. So that's the balance minus the losses. divided by the used margin times 100. So that's 120%. So we are approaching the 50% margin call. We're approaching that 50% margin call. It won't be called yet, but when that number reaches 50%, you're gonna get the margin call. Now, what is the stop out level? Stop out level is a level at when the broker starts to close the least profitable open positions, okay, in order to free up some margin. Okay, it's gonna start closing those positions. So let's say the margin call is at 40% and your margin level keeps going down. And let's say the broker, they said the stop out level is at 20%. Once that margin level hits 20%, they're gonna start closing the least profitable open positions. They're gonna close those positions to free up more margin. So that's when people say margin call, and they talk about blowing an account, this is it. You taking your margin level all the way down. It's easy to do when you have 1 to 500. If you're leveraging, trying to purchase a big amount, you're trying to purchase using this $50,000, it can be easy to blow that money. Okay, so sometimes the challenge here, you don't want this to happen. Why? Because sometimes you may go in a drawdown, but the price will go back in your favor. But if it goes too far into drawdown, it'll take you out and then go in your favor. So you'll take that loss, right? So most of us won't have to deal with this because we're doing the funded accounts. So our risk management will be really tight. I'm going to do a section on growing small accounts, which is a lot harder. But I'm mentioning this because when you get to that level, or if you're a type of person that wants to do a challenge of flipping an account, you need to be aware of these types of things. All right, so we're going to go into what a PIP is, right? So, and again, I'm just going to briefly cover these, recap. Most of you have already learned these definitions, but again, I'll do a detailed video if you want me to. Just let me know. So this is a unit of measure used to express the change in value between the two currencies, right? So the PIP is normally the fourth number here. So it's the fourth number, okay? That's how you measure PIPs. This one was recently added, but historically it was the fourth number here. So whatever this number is here, if price was to go to 1.1235, then it increased by 1 pip, okay? Increased by 1 pip. So you know what pips are. Many of you all know. I'll go into this in greater detail if you need me to, okay? All right, and then certain currency pairs are special, like USD, JPY, where the pip is in the, so they have 3 decimals instead of the 4. Okay, so that's something that we can go into if you need that level of detail. So we're talking about a lot. So the lot is it's the amount of the currency pair that you are buying or selling. Okay, and you all have studied lots, so I won't go into detail. This is just a primer. This is just a reminder. And if you need me to cover this, let me know. Now, I'm going to talk to you about the bid. We talked about offers and ask prices, etc. When it comes to stocks, we talked about supply and demand. But in Forex, as we know, the bid price here is the price you sell, and the ask price is the price you buy. So when you look at your chart, we talk about turning on the ask price because you need to know that there isn't just one price. Sometimes we look at that little ticker moving, we think it's just one price, but no, there's a bid price. That's the price you sell at, and there's the ask price. This is the price you buy, and those are 2 different prices. And between the 2 of them, you have what is called the spread. Okay, this is the difference between the ask and the bid, and we want tight spreads. We want very tight spreads. And the reason is because the difference of if you have widening spreads based on the time zone, based on the session, or based on the liquidity for the pair, you can be buying at a much worse price than you anticipated, and it's going to cut into your earnings. Okay, so that's another conversation. But That's the spread. Now, what is the long? This is a term used to describe buying in anticipation of an upward move, right? So going long, that's buying, right? Going short, that's describing selling, right? In anticipation of a downward move. So that's what the short is. And now let's talk about the market type, market order types, right? So market execution, this is a mode of trade where you execute an order at the price that is currently offered, okay, in the market, the current market price, okay? So here, this is called the bid price, right? So if you're selling, this is the price that you're selling at. This one is called the ask price. And if you're buying, this is the price that you're buying at, right? So these are the current market execution prices. These are the current prices that you want to that you'll have to execute at if you want to get the order filled right away. Okay. Now sometimes these prices may be higher or lower than you anticipate, so or that you want to buy or sell from. So we have what are called limit orders, right? This is an order to open a trade with a maximum or minimum price, right? So a maximum that you want to pay or a minimum that you want to receive, right? So if price is up here, you may not want to buy up there because that may be too far from your entry or your stop loss. You may have a larger stop loss than you like. We want to reduce the level of our risk exposure, right? So meaning we may want to wait till price comes down and then buy. So we would put a buy limit order there. And oftentimes I put these orders at 50% of the candle, right? Of our entry candle, so that I won't enter here. I can get a smaller stop loss with so that will give me a better R&R. Okay. So it's the same. Sell limit is you're waiting on price to come up here to fill your order, and then you'll be selling. Okay. We have what is called the stop orders. Okay. You have the buy stop and the sell stop, right? So this is in order to buy or sell at the market price once the stock or currency or commodity has traded through a specified price, right? So the buy stop is saying, okay, when the price is moving aggressively here, then place a buy for me. Okay. When the price is moving aggressively with the sell, you have aggressive sellers. Then when price gets to this certain point, then sell for me. So the reason why you may want to do this is you may want to see like price may be here and it can continue to go up, but you may want to catch a trade at a certain price point. You might want to catch aggressive selling or aggressive buying at a certain price point. So you may place the buy stop or the sell stop. These are especially good during news releases, news data releases, right? Like CPI, for example, with US 30, sometimes it's sitting on our zone and we would trade it, normally looking for a candle or break a structure on a lower time frame. But those releases make strong spikes, right? They cause strong spikes up or down. So normally we may not be able to catch those if we are looking for the candle. So we can use a buy stop or a sell stop to catch that momentum up, and then we can exit when needed. So this was just a small review of concepts that many of you already know, but I just wanted to cover it just to allow anybody to see these concepts and say, oh, you know what? I want to see more on a specific concept, or can you go into them in greater detail? Please leave your comments and questions in the section below. See you in the next video.